Hello, friends, and welcome back to Market Shares. I'm your host, Tony Blodgett, and today I'm going to talk about the Fed rate cut. Look, you've probably already heard a bunch of videos and commentary on this, but I have my own little take on this. And if you follow me on social media, you saw that I think it was the day of the rate cut, or maybe the day before, I put a pretty long post up on my Facebook page because I have a little bit different opinion about what the Fed needs to do to get things kind of in line. I was anticipating a 50% basis point rate cut, which is what we had talked about on a couple different episodes here on Market Shares. And in fact, that's what they did. So that's not the big news. We know that they cut rates by 50 basis points. I think many people were surprised by that. I was only surprised in that they did what I thought they should do. So that was a little surprising, but I think it was necessary. And I think further rate cuts are necessary. And what a lot of people are saying, matter of fact, I'm going to throw a slide up right here on the screen that you can see. This is just one of many examples. This is the Chicago Fed National Financial Conditions Index in the blue versus the change in the Fed funds rate, which is the white lines. And what this is telling us, and what everyone is saying, is that we don't have the financial conditions today that warranted a 50 basis point cut out of the gate from the Fed. And this is what I acknowledged in my post on Facebook, was that, if you look back historically, in 2019, the Fed started cutting rates. They just did a quarter. And in two other times in the past, the last two Fed rate cuts, they started out at 50 basis point cuts. What this is saying is that, with financial conditions in the shape that they're in today, we haven't seen a Fed rate cut like this in 32 years, right? So meaning if you look at the rate cut in relationship to financial conditions, this is like, a lot of people are thinking it's out of line. And that's what I want to talk about here briefly, is that I don't think that it's out of line. And the reason why is because even if you look at that chart, you can see what the Fed did when COVID hit, right? Back in March of 2020, they dropped it down to zero like instantly. And I kind of liken this to, all of us take showers every day. Hopefully you take a shower. And I don't know about you, but when I get in the shower, I typically don't just turn it to where I think warm is going to be. I usually crank it up to hot, wait for it to get hot, and then I turn it back to the middle, right? To turn it back to warm, that neutral kind of temperature that's comfortable for me. That's the analogy I would use for what the Fed is doing here. Look, they did what was necessary to fight inflation. And did that in 22 and 23 and really crank things up, right? We also saw them do what was necessary in COVID, right? That big drop I was talking about. So we've seen them take these drastic moves. But look, inflation was pushing 9% at one point there, and they had to really crank it up. And so now what they need to do is they need to get us back to a neutral position. Now, obviously, we're not going to see the Fed take this all the way down to zero again. Matter of fact, Jerome Powell was asked about that in the Q&A, and he does not see a future where we have, these zero interest rates, which is a little concerning to some. Matter of fact, it's part of the reason why I believe the market didn't rally as much as people were anticipating, because people thought this was going to be a slow march towards, zero interest rates again from the Fed. And he made it pretty clear that that is not their intention to do that. Now, they may have to at some point, but it's not their intention to get us there. So the market didn't love that because people like free money, and the market likes when the Fed is that low. But that's not the direction that it's going to go. So my point being this is that, yes, we are not seeing these crazy bad financial state of the economy today. So it may feel like 50 basis points was more than necessary. My argument is that we took drastic measures to deal with inflation, which, although it wasn't transitory like they said, let's be honest, it was a lot attributed to the pandemic that was going on at the time and the aftermath of the supply chain issues and all that. So some of it was transitory. It was took a little bit longer than what they expected, right? It was like a long transit in that transitory, but nonetheless, it was still, to deal with that. Now, other things like the stimulus that was done and all the printing of money and all of those things added to the inflation as well. But a lot of it was, which was also due to the pandemic, but more of a long-term impact versus like a supply chain issue, for instance. So my feeling is the Fed's going to continue to move rates down, and the reason we didn't see a big lift is because two things. One, a lot of it was already baked into the market. If you watch mortgage rates closely, I mean, we had already improved over a point in interest rates in most products and programs before the Fed rate cut ever happened. And secondly, it's because, although he was aggressive with this first move, they didn't like the comments about, not letting us get all the way back down. But so that's kind of my take. I think the Fed got it right. I think they'll continue to be aggressive. I think they need to continue to move quickly. They probably won't do another 50 basis point drop this quickly, but in my opinion, they are behind the gun because they need to get us back to a neutral stance. The economy, in many ways, stock market and employment's not horrible. Although if you look at where it was a year ago, it looks pretty bad. But historically speaking, 4.3% unemployment is not horrible. But if they're not careful, things could go off the rails. So they need to get us back to a neutral policy as quickly as they can. And this was the right start, in my opinion. So there's my take on the Fed taking a half point, even though the economy doesn't feel like it really needed it. But we do need it, and it was the right move. Now, the other thing I want to touch on here, I got a couple slides, and I want to give a shout out to Dan Rawich, as I've done in the past. These slides come from his market mentor report that he put out. There's a bunch of slides here. I'm not going to touch on all of them, but I thought that first one was important. The other one I want to touch on, which I thought was really cool, and I think you guys will think is very cool as well, is this one that I'm going to pop up here. What this shows is that historically, and you can look at the big circles on this graph, those are when the Fed finally started easing rates. Each of those cycles is when the Fed started easing rates. Now, the two lines on here are the mortgage rates, which is in the blue, and you can see where that question mark is. They're still very high. They've come down, as I mentioned, but they're still very high. The red, though, is the effective rate of interest on mortgage debt that's outstanding. That number looks to me to be around 4%, low fours. What's really cool about this graph is that every single time the Fed has started a cutting cycle, that mortgage interest rates have crossed and or, in most cases, declined below the effective rate of interest on outstanding mortgages. That means that based on this graph and based on history, we should see mortgage rates at some point in this cycle cross over that red line, which would probably put us in the low fours. This is the first graph that I've seen that really would give you any sort of historical measurement as to why it would be logical rates would go into the low fours. Now, a lot of people say that they think that they will, but I've never seen it illustrated in this way. So I wanted to show you this graph, and it gives me some optimism about where rates could go. The other slide that I want to mention really quick, we're going to keep this as a short episode, but this one's really cool. And what this shows is it's really just a bunch of words on the page. So I'll pop it up here so you can see the amount of red that's on here, but you probably won't be able to read it. I'm going to read a few of these key points. And this is showing you the Fed's statement when they made their rate announcement versus the previous statement that was made in July. So what they do is they go through and they basically do a red line version so you can see side by side what are the changes that the Fed made. I want to point out just a few of them. So one of them was they had said previously that job gains have moderated, and they changed moderated to slowed. Small tweak, but significant to tell you where the Fed's mind is at. They are acknowledging jobs are slowing. That's the first one. Inflation, it used to say inflation has eased over the past year, remains somewhat elevated. In recent months, there have been further progress towards the committee's 2%. That whole big, long words. They got rid of all that whole sentence, and it just says inflation has made further progress towards the committee's 2% goal. So all this qualifying language gone, and just said, look, it's very clear that inflation has made progress towards the goal, versus qualifying it with all this other fluff, which to me says a lot about where their mind's at. They added a whole sentence here where it used to say the committee judges that the risks to achieving its employment and inflation goals, blah, blah, blah. I'll get to that in a second. They add this whole sentence, has gained greater confidence that inflation is moving sustainably toward 2%. And then it goes on to the rest of the sentence. So they added that whole series of words there that have gained greater confidence that inflation is moving sustainably toward their 2% goal. And then there's not, those were kind of the main things I wanted to point out here. They also used to say in support of its goals. It now says in light of the progress on inflation and the balance of risks, the committee decided to lower the target rate versus maintain the target rate. Obviously, we know they lowered rates. So anyway, I thought that was very interesting on a few fronts, mostly the one around employment and their confidence in that we are on track for reaching their 2% target. As you guys know, the Fed has a dual mandate, right? It's maximum employment and it's keeping inflation under control. And so they changed language this meeting on both of those topics fairly significantly. If you look at this in the past, it had made very minor changes, nothing like removing whole sentences and changing their stance on employment and inflation. The last slide I'm going to show you guys from this is the dot plot. So you guys are probably familiar with the dot plot. You've heard us talk about it and others talk about it. This is where the FOMC participants are expecting rates to be. This is not a predetermination of future policy. It's just kind of like a survey on where they think that they're going to be. So it looks like we have about 2 Fed members that think that they don't change by the end of 2024, which is represented there by the 2 dots. But the majority of people thinking a quarter or a half, with the majority of them being, or more than any other category, suggesting 50 basis point reduction by the end of 2024. Then we see 25, and then we see 26. 25, they're seeing then another 100 basis point reduction, is where you see the bulk of the people there at 3 to 3.25 or 3.25 to 3.5, versus right now we're at 4.75 to 5. And then in 26, I would say the majority of the people are at 2.75 to 3, which is 2 full basis points, or 200 basis points lower than or 2 points lower, for those of you who don't speak every day in basis points like I do, 2 points lower than where it's at right now is kind of where the majority of people are. There's definitely some that think less and some that think more than that. But this is, and then you go to 27, and then in the future, it kind of looks about the same, right? Not a lot of changes there. And so I think it's interesting to point out. Now, we have talked in the past about mortgage interest rates and where the gap is between the Fed funds rate and mortgage rates. So, there is a correlation between the two. It's not a direct correlation, but I think all this points to not only lower mortgage rates, but lower mortgage rates over a longer period of time. Meaning, we think it's going to take a while to get there. But if you think back to that first graph, it gives us a lot of optimism that we could see mortgage rates get into the low 4s based on what has historically happened with mortgage interest rates versus the average outstanding interest rates in the past. So anyways, I just wanted to give you guys a little more information. This has been digested and talked about by so many people. But for me in particular, seeing the words that were changed by the Fed side by side, really looking at this dot plot for a second and then seeing historically what's happened with mortgage rates gives me some confidence. Last thing I'll say here is this is not going to happen overnight. I think a lot of people, and look, myself included, right? Like I would love to see just a big drop in mortgage rates and a refinance cycle come back, and we can help so many people that we had to put into these high interest rates that are just dating their mortgage right now, and they want to get a new one. I want to help them all, and we can help some of them, right? There's definitely opportunities to refinance. As I mentioned 2 weeks ago, don't forget this, 50% of mortgage applications right now are refinance applications, 50%. If you're not doing 50% of your pipeline is refinances, then I ask you, who's doing those loans for your clients? Because somebody is. So look, our clients could benefit from refinancing, there's no question. But as far as how this move is going to happen, I will say that as much as I thought it'd be 50 basis points, I thought we'd see a bigger rally afterwards. And I was a little bit surprised that even since then, the market's been pretty flat since the Fed rate cut. But I think you will continue to see things improve and move down. I think employment continues to have struggles as we've seen all those revisions to the employment numbers. We know a lot of people are working second jobs, third jobs, etc. That's not super sustainable for people. So, this will take some time to work through, but I still have very high confidence of better mortgage rates moving forward. And the Fed will continue their march to lower this. I hope they do it quickly and get us to a more neutral stance. The last thing I will say is that I was listening to a podcast yesterday, and as far as the whole soft landing, remember we did an episode about no landing? Like there's going to be no, like for the next 12 months, we're not going to have a landing. That still may be the case, right? We haven't seen a landing yet, but it looks like more and more people are starting to think that when we do have a landing, it's going to be a recession type landing as opposed to a soft landing. So it's more and more people now thinking recession is a possibility. Again, not a bad thing, not great. Good for mortgage rates typically when you see a more marketed recession. But it does, based on what I'm seeing, maybe I'll do a larger report on that as more information comes out. But it's kind of tilting more towards the recession side of things as this thing comes to a landing. So it'll be interesting to see what the Fed does. And as always, we'll keep you on top of it. I'll give you my take on it. There's lots of places to get breaking news on what the Fed is doing. So I'm not going to always try to bring you the breaking news because that's not really where I think I can bring value. But little stuff like this that maybe you didn't hear somewhere else that hopefully helps you better understand what's happening and gives you some cool things to talk about with your referral partners and other people in the industry. To that end, if you think people would get value out of this episode, please share it with them. That's the number one thing that I can ask people to do is refer market shares to someone say, hey, check out this podcast. They do some cool stuff. Obviously, if you subscribe to the channel, you'll get notified every single Friday when we drop a new episode. But let someone know. Let's spread the word. If you could help me out in that way, I would greatly appreciate it. And until next time, take care.